You've been reading the newspaper and all recently, whether it's the Wall Street Journal or the Atlanta Journal-Constitution or any of your local newspapers. You will see that there are lots of ideas on major tax reform, and they're all being discussed and debated. And Georgia has talked about fundamental tax reform for many, many years, and it looks like we are at a point where it really is going to happen. And we believe very strongly, like with all public policy, that needs to be based upon a foundation of facts and good economic policy. So as we sort of set the stage for this fundamental tax reform, we wanted to call on the experts, and that's the Tax Foundation. They've been around since 1937. They're a nonpartisan research group based in Washington, D.C., and their mission is to educate taxpayers about sound tax policy and the size of the tax burden borne by Americans at all levels of government. You've probably heard of Tax Freedom Day, how long you have to work to pay your state, local, and federal taxes. Tax Foundation comes up with those calculations every year. They are grounded in a belief that the dissemination of basic information about government finance is the foundation of sound policy and a free society. With us today, we're pleased to have Chris Atkins, who is the staff attorney for the Tax Foundation. Before joining the Tax Foundation, he was Director of Tax and Fiscal Policy at the American Legislative Exchange Council, where he spent his time traveling all over the country meeting with state legislators on these fiscal issues. So he has a tremendous amount of experience in state-level fiscal issues. And also Jonathan Williams. He's the staff economist at the Foundation. You may have seen his work featured in the Wall Street Journal, USA Today, the Los Angeles Times, the Washington Post, Investors Business Daily, Forbes, Barron's. He's been on Scarborough Country, Fox News, World with Neil Cavuto, and various radio shows. But most importantly, this is a very interesting fact, he represented the United States as a member of the men's national fast-pitch softball team in the World Championships in Sydney, Australia recently. Jonathan, you're not going to get any softball questions today, in more ways than one. Let me introduce the Tax Foundation to give you a presentation on a study they've recently done on Georgia's tax code. Thank you.
We're here not because we have a political axe to grind. We're here not because we have a horse in this race. We're here because we are concerned about sound tax policy, and we believe Georgia has a great opportunity to pursue fundamental tax reform in the upcoming future. And so what we have today is put together a PowerPoint that will go over several areas of the tax system. I'm going to show you in several ways how Georgia compares both nationally and regionally, how their tax system compares in a competitive perspective. And then Chris is going to outline some foundations for reform that are a necessity if the end product that we're all looking for is going to be achieved. So when we go out to states and analyze tax policy, we focus on several areas. And there is really no ideal tax system, but we can be pointed in the right direction based on a couple of criteria that we use. One of these is what we call the principles of sound tax policy, which we focus on at the Tax Foundation. And those are listed there. First being neutrality, is that the tax code should not pick winners and losers. Unfortunately, we see that all too often at the federal level and state level, but should treat all taxpayers equally. Second is the tax system should be as simple as possible and reduce compliance burdens on taxpayers. Next, a tax system should be as transparent as possible. Taxpayers should be able to easily see how they are being taxed. And also a tax system should not inhibit economic growth. Another way that we is another good benchmark for tax systems is looking towards what other states do and how effective their tax structures are. And there's a couple models as far as this measurement go. One model is that states do very well competitively is if a state can go without a major tax. without a state income tax, without a state sales tax. Those states generally do very well competitively. There's another method that we can use, is the Colorado method, I like to refer to it as, where states, if they have all the major taxes, those taxes are levied with a broad base and at a low rate, and are also very competitive. Colorado has had a competitive tax system for years. And we believe, taking a look at tax structures, we should analyze tax burdens and also the structure element of the tax code. And both the burden and structure are very important. For instance, if you analyze a state and see that tax burden is too high, it won't inherently give you areas that you can recommend changes to the tax code for positive changes. But if you analyze burdens, or if you analyze structures, it will give lawmakers concrete areas that they can improve on. And if we take a look at this example between two states, it should highlight the importance of structures. So if you take State A and State B with the same amount of business income for a business in those states, and then you take a flat tax basically as State A, so the companies can forthrightly find their tax liability, and then State B, you have a system of credits that's very, very common out in the states today. They end up with the same ending tax liability, so they have the same tax burden, but the structure is very different. And so it's very clear which tax system is better. The plan State B adds a whole layer of complexity. And so while State B may be good for tax accountants and tax lawyers, no offense to any that might be in the room, it definitely would not be the system that would be good for Georgia's economy in the long run. To give you a little bit of estimate when we talk about tax burdens, basically it's a percentage of personal income that is taken by the government in the form of taxes at all levels. And what we do is that we have a burden estimate that we do annually, both nationally and based on state by state. And that estimate is based on state and local taxes. The U.S. Census Bureau, you're probably familiar with some of the collections data that they put out. That is done on a state level and neglects the local taxes, which are very important and follow more along the lines of economic reality for taxpayers. Another reason that Tax Foundation burden estimates are preferable to Census Bureau is that Census Bureau just takes into consideration collections and payments made by companies, but that really doesn't tell us the whole picture. What we do is we look at economic incidents to where who bears the full burden of that tax in the long run. There's a good example to highlight the difference between legal and economic incidents as far as taxes, and that's Wyoming. Wyoming is a state that's rich in natural resources, and so the Census Bureau ranks them as having a very high tax burden because they collect many natural resource taxes, and obviously those payments are going to the state. But if you look at it in an economic sense, it defies economic reality to say that Wyoming has a high tax burden, because we know that residents of Wyoming do not bear that burden of all the energy taxes. That burden is spread throughout the country through energy consumers. And so to get a real grasp on Wyoming's tax burden, you have to use economic incidents, and that's how Tax Foundation calculates our burdens. And that's why Tax Foundation estimates are more along the lines of economic reality than Census Bureau. And you might have seen that last slide there, how Georgia compares nationally. In terms of tax burden, it's right in the middle. It's 25th nationally in 2006. But regionally, the Southeast is an area where a lot of states have very competitive tax systems. And so Georgia is second highest in the region, just behind North Carolina. It was kind of interesting studying Georgia taxes. The movement, we started doing the rankings as of 1970 up to the present, and it was very interesting to see the movement in towards higher taxes that Georgia's seen since 1970. It was, a below average state tax burden in 1970. Today we've seen that really grow, and I think we'll get to a chart there later that'll show that. And as Kelly mentioned, Tax Freedom Day is April 22nd here in Georgia, so meaning that you work for Uncle Sam January 1 through April 22nd, and the rest of the year you can keep what you earn. That just shows you where the other states are in the region as far as our tax burden estimates. As you can see, Georgia's near the top, with Alabama and Tennessee lagging far behind. And that just shows where those states rank nationally. You can see Tennessee and Alabama are among the lowest tax burdens in the nation, not just the region. And I was mentioning before the historical perspective, and you can see that over those 36 years, Georgia's tax burden has increased nearly 20% as a percentage of income. And you can see a couple of the states there really didn't have much movement at all over those years. And that's where the other states in the region rank with the Tax Freedom Day. So as I mentioned before, tax burdens are not the only area that we need to analyze. Tax burdens are one side of the equation, but a very necessity on the other side of the equation is structure. And that's why we put together what we call our State Business Tax Climate Index as a tool for lawmakers and citizens to evaluate how competitive their tax system is in the regional, the national, and the international marketplace. And the foundations for the index are based on the premise that taxes matter to business. And that's something that every business owner can tell you. It's intuitive to them. Taxes affect the bottom line more than anything else that government influences with business. Taxes are important for economic growth is also another. What we did is we did a study of the top 10 states that we rank as having the most competitive business tax climates versus the bottom 10 states. And over the last few years, the economic growth between those two, the divergence, the states with good competitive tax systems do better in a lot of areas. Personal income growth, overall economic growth, population growth, you name it, those states perform better. And it's important to remember that tax changes are not made in a vacuum, because every change that a state makes to their tax policy affects their relative competitive position to other states for capital investment. And this goes through and shows you the areas of taxes that we analyze in the State Business Tax Climate Index. We realize that taxes are not the only thing that influence business investment decisions. As I'm sure the Secretary pointed out, education is very important also, as well as a good legal system and sound roads. But the thing that differentiates taxes from all these others is that it's the only thing that affects the company's bottom line. And it's the only thing that lawmakers can influence in the short term as well, if they wish to have their state have a jump start on the competitive process. So really, if you neglect your tax system, have a great education system, and have great, roads, your well-educated kids are going to leave your well-paved roads and look for other states for work. That's the reality of it. This slide will go through and show you how Georgia ranks in our State Business Tax Climate Index, both in the overall index ranking. As you can see, it's a slightly above average at 19 out of 50. And then it will go through the component indexes of both of corporate, individual, sales, and property taxes. The corporate tax index scores Georgia relatively well because of a single rate and a very good base on the corporate side. On individual taxes, it's nearly average, partly to do with the many brackets that you have. Sales taxes, you also rate very well nationally, sales taxes, because of the low rate and many business-to-business transactions being exempt. And then property taxes, you find yourself just about in the middle of the pack as well. One easy area to improve in this category would be to eliminate the capital stock tax. Then we'll go through and look at Georgia's corporate tax rate in comparison with other states in the region. As you can see, it's about average there. One thing to note is that, competitively speaking, Georgia has little room for error in this region, because Florida, your neighbor to the south and a big competitor, is one of the most competitive tax systems in the United States, ranking 5th most competitive in 2007. And then taking the corporate tax rate in Georgia and adding the statutory federal rate of 35% means that any corporation looking to start up operations in Georgia is automatically facing a 41% rate. And to put that in proper comparison, a 41% marginal rate that a company would face starting here is more than a company would face if they were looking to start operations in France or Sweden. And that's because of the federal corporate tax rate is just a huge burden on states, and there's really not much they can do about it. At least that aspect. The thing they can influence is, obviously the state rate, which makes a big difference on the marginal scale. And as we can see where Georgia ranks with the top individual income rate, and you can see their neighbor to the north and neighbor to the south have extremely competitive systems with no individual income tax. And as I mentioned before, Georgia's 6 brackets on the individual scale is tied for the most in the region. And then if we looked at property tax collections, you can see Georgia is near the top in the region, following Florida as being quite high. And then as a percentage of income, which is probably the best way to use property tax, the best way to compare collections, you can see Georgia is also on the higher end there. And as I mentioned before, Georgia does have a capital stock tax, although it's very small in comparison to other states. But on a proactive side of things, that should mean that it's a pretty low-hanging fruit for lawmakers to eliminate. It shouldn't cause much pain in the budget whatsoever. And really, capital stock taxes are a relic of the past. They're something from 20th century tax systems, and they just add a added layer of complexity, compliance costs to the corporate tax system. And so it would be something that would be very good to take a look at. So now to lay a foundation for tax reform efforts, I'm going to turn the presentation over to my colleague, Chris Atkins, who's our staff attorney, as Kelly mentioned. And Chris is an expert in state tax systems. And Chris, I'm going to turn it over to you.
Thank you, Jonathan, and thank you to everyone for coming today to hear our perspective on your tax system. Jonathan just laid the factual foundation for you. Here's the facts about where you rank. And I guess to sum up his remarks, Georgia has an average tax burden compared to other states. You're right in the middle, 25th, and you have a slightly above average tax structure. Those are the facts. And if those facts lead you to the conclusion that you want to do fundamental tax reform in Georgia and you think it's necessary, then it's also important to get the first couple of next steps right. And the next steps are, how do we lay the theoretical foundation to do fundamental tax reform? What are the principles that we're going to sift through all the different competing plans and choose which plans we're going to reject and which plans we're going to support? The steps you take now, once you've decided you need to do fundamental tax reform, the first couple of steps you take are going to impact the final steps that you take in the system that you get. We see this happening right now in the state of Michigan. Michigan has a tax called the single business tax, which is a very unique tax. There's no tax like it really anywhere in the world. It's an additive method value-added tax, which is different than all the European value-added taxes. But it's very onerous, both in the amount of money that it raises and in how it raises that money. There's no accounting for profitability when you pay the tax. There's a large gross receipts component with all the economic problems that come with that, which we'll talk a little bit about in a minute. But they decided that they wanted to repeal the tax there. But the problem is that the groundwork that was laid by both parties when they decided they wanted to repeal the tax is that we're not going to replace this tax on business with a tax on individuals. And so right away, sales and the individual income taxes were off the board as possible replacements, all because of the insistence that the tax burden not be, quote unquote, shifted from businesses to individuals. Well, as I'll show you in a minute, businesses don't pay taxes. And so they got started on the wrong foot, and because they did, the proposals that are being offered to replace a single business tax are flawed from an economic perspective because of these constraints that the political process has put on fundamental tax reform. So that's just a caveat for you and a warning as you get started on this process that you really have to lay down the ground rules. What are the principles that we're going to use in designing our tax system? And then you have to follow through on those. Otherwise, it'll just be based on pure politics, and we might have to come back in a year or two and help you fix the tax system that you created. So we would suggest that you be committed to the core principles of sound economic tax policy, which Jonathan outlined. Simplicity, transparency, stability, neutrality, and pro-growth. Again, understanding burden versus structure. Both are important. If your goal is to reduce the burden, which right now the way it sort of looks, the way Georgia looks compared to other states, you might want to focus more on your burden in the short term, getting that more in line with your structure. But not all tax cuts are created equal, believe it or not. There's a right way and a wrong way to cut taxes. So you want to pick the right taxes to reduce or eliminate in order to get your burden down. And then I just mentioned this, but this is an important one to get right, and it's the fact that people pay taxes. Paper entities don't pay taxes. Buildings don't pay taxes. People pay all taxes. And that's why we're seeing a lot of states right now move in the direction of fundamental business tax reform. Not just tax reform, but business tax reform. I think it's nothing short of a miracle that states are looking to reform their business tax systems because of the politics involved, which we've seen in Michigan. But a lot of these lawmakers are getting this fact that a tax on our businesses is a tax on our people, on our productive capacities. It's a tax on wages. And you can see that in this graph right here. This is just a very simple example of how people pay taxes and not businesses. You have your business in the middle, which we'll call ABC Company, which remits $60 in taxes to the state of Georgia. Well, it's going to recoup that tax, or it's going to conduit that tax to one of three people. Workers in the form of lower wages, customers in the form of higher prices, or investors in the form of lower returns on investment. By the way, recent research has indicated that corporations are starting to put a lot of their business tax burden on workers. In fact, one recent study said that businesses will pass on tax costs as much as 70% to their workers. So business taxes in Georgia are really a tax on wages for your workers. And it's a foregone opportunity for them to make wages. So you have to get this idea right before you embark on fundamental tax reform. Because people aren't really connecting with the idea that businesses pay taxes, or that people pay taxes, we're seeing a lot of states move in the direction of gross receipts taxes, which are a dinosaur from the 20th century that a lot of states tried back in the 1920s and 30s, and most of them who have tried it have repealed it. And it's because they violate many tax policy principles. And we have two reports that we've done on gross receipts taxes which explain why, and I'll just I'll refer you to our website if you're interested in reading those. But I wanted to make sure that I mentioned that today, because as you move forward with fundamental tax reform, there may be a pressure to adopt a gross receipts or a gross receipts style tax. And for all the reasons we outline in those papers, we would urge extreme caution before looking into that. And finally, I'd just like to remind you that other states are moving. Georgia is not the only state considering fundamental tax reform. Indeed, there are 10 to 12 states that are doing so right now. We were in Michigan last week where there's a big debate. We're going to be in Kansas in a few weeks where a Democrat governor has proposed corporate income tax rate reductions and a repeal or a partial repeal of the state's corporate franchise tax. So not only are other states moving, but other states are moving in a bipartisan manner. And states lawmakers are starting to get the fact that there's a competition for capital investment in the world, and that taxes are an important part of how you compete for your investment in your state. And instead of trying to pick winners and losers or trying to give handouts, many states are looking to their tax code to try to remove as many impediments as they can to that investment. Here's just a brief example of the other states that are looking at tax reduction or tax reform right now and what they're looking at. Texas, looking at business tax reductions, just last year they passed a tax reform plan that was pretty much forced on them by their state Supreme Court, which ordered a fix in the state's education funding system. As a result, they have a new margins tax there, which our friends from Coca-Cola were telling us that they're loving because it's basically doubled their tax burden. But it's a form of a gross receipts tax. It's not a pure gross receipts tax, but it's a form of a gross receipts tax. And there's been a fair amount of clamoring there, and they have a decent-sized surplus this year, so they might reduce that rate or look to reduce that burden. In Kentucky, continuing the gross receipts tax theme, they have an alternative gross receipts tax there, and it's so hated that they're already going to repeal it, and it was only put in place about 2 or 3 years ago. But there's Kansas with corporate taxes. Of course, property tax relief is a big one, and I haven't listed a lot of states up here that are looking at property tax relief. But you can see it's pretty much across the board in all different types of taxes in many different states that lawmakers are looking to make changes. And as those lawmakers make changes, it will make Georgia, in most of these cases, less attractive from a business perspective, looking at the bottom line and the tax cost of making an investment here. Well, okay, so we catch flack sometimes when we go to states and we say you shouldn't do this, you shouldn't do that, avoid this, avoid that, and then the question we get is, well, what should we do? And so there are some recommendations that we can make just based on how you rank in our tax burden estimates and in our business tax climate index. But I guess the first thing I would recommend is, do you want to do fundamental reform or do you want to do incremental? And that's really going to determine, what kind of options you have. Do you want to be in the top 10? Do you want to be a number 1 or number 2 or top 10 state in terms of your tax system? Or are you content with your current position? Again, this answer will impact your reform debate and the plans that are generated. I just showed you a slide of a bunch of states that are looking at business tax reform. On structure, Georgia's ranked 19th. So I said that position could be in jeopardy given what some other states are looking to do. So it may be that you just need to do a few things just to keep your current ranking. But if you're going to do incremental reform, here's a couple of things we think you should look at from a competitive perspective. Jonathan mentioned eliminating your corporate franchise tax. Again, these are really dinosaurs. I think the tax liability is capped at $5,000 per company, so it can't raise a lot of revenue, and it's a 0.023% rate. So that's low-hanging fruit, I think, if you want to do incremental reform. Other types of property tax relief. You tend to rank, I think, on property taxes is your worst sub-index ranking in our index, so you may want to look there. I know there's been proposals for the personal property tax floated around here. We think that would make a lot of sense just based on where you're ranked. Exempt utilities, other business-to-business from the sales tax. I know there's a proposal floating around to exempt energy from the sales tax when a business purchases it. Really, every business input should be exempt from the sales tax. Economists on the left and the right miraculously agree on this. So that would definitely be a good step in the right direction to exempt your businesses from sales tax. And then flattening out the individual tax. Those 6 brackets are hurting you in our rankings. You're tied with, I think, South Carolina as having the most brackets in the region. Well, if you want to get in the top 10, fortunately or unfortunately, you're going to have to eliminate a major tax. Pretty much I think all 10 states in our top 10 in the index and in our burdens go without one of the major taxes. So to get real solid movement, you've got to look at eliminating a major tax. I know there's some talk here about doing that. That would get you into a top 10 status as a tax state. And then burden or structure. I've already talked about this a little bit, but do you want to reduce the tax burden, or do you want to improve your tax structure? You've got to ask that question. And again, not all tax cuts are created equal. Jonathan showed you that example. And you can reduce the tax burden a lot of different ways. But the most efficient way to do it from an economic perspective, the most fair way to do it, is just to reduce your tax rates. And also to reduce the tax rate of a broad-based tax, which applies fairly equally to all people. Using special credits or deductions is not the best economic way to reduce your tax burden, though it will reduce your tax burden. So, in conclusion, again, average tax burden, slightly above average tax structure. There is room for improvement, as there is in almost any state. I was in Montana in December. I think they're ranked 9th, and they're looking, you know, they want to go up. So there's always room for improvement in a state's tax system. And again, you got to lay the right foundation. Don't be like Michigan. Don't get started on the wrong foot, because you're going to end up making a policy mistake and choosing the wrong mix of taxes for your companies and for your people. And don't forget structure. Those of you who want the government to get out of the way, to create the conditions for economic growth, to take the least amount out of our pockets as possible, don't forget about tax structure. You know, spending, I'm a lawyer so I can say this, spending money on lawyers to figure out taxes is not the way to grow your economy. We have to get to the point where we see a complicated tax system as just as much a hindrance to growth as we do a high tax burden and high tax rates. Until we do, we're going to continue to see the types of things we do in Michigan and other states where there's absolutely no thought given to the tax structure, and it's all just about reducing the burden, which is fine. We've got to reduce the burden, but we've got to do it the right way, or we create a whole host of economic problems for our people and for your competitive position. Thank you very much for having us today. We are happy to come back anytime to help you with any aspect of tax reform. Thanks to Kelly again for having us here. You've been a good friend and partner with us over the years, and we look forward to your questions. Thank you.